We're waiting on somebody else, but we're just gonna get rolling due to time. All right, so let's get this party started. All right, welcome to Next Level Trading, guys. We're gonna get into some very deep content today. Now, last session was very deep as well, but we're gonna go a little bit more deeper. Things may become a little bit more complex. Hold on, let me turn this down a little bit. All right, so I hope you guys got your pen and paper ready. I also want to let you guys know that we have a quiz on Friday, and the person who has the most points is going to get a special little treat from me. So, you know, you guys, I hope you guys are watching these recordings and actually studying these recordings because we actually have a quiz on Friday. So you guys get ready for that. All right, so let me actually fast forward here a little bit. All right, cool. So today we're going to talk about a little bit about Fibonacci patterns and also harmonic patterns as well. So we're going to start off with talking about what is a retest. All right, so a retest is also known as a kiss of death because after that last kiss, after that last retest, the market is gone. It's not coming back, and you're usually looking for a big gain. A retest is when the market breaks out of either consolidation, an uptrend, a downtrend, or a wedge, and then comes back to either support or resistance line one last time before heading in the opposite direction. A better form of entry in comparison to just entering on a breakout without a retest. Okay, cool. So like, you know, in the last class, I talked to you guys about this pattern here. One second. In the last class, I talked to you guys about this pattern here. And so, you know, this is a nice pattern. This is just an example. But for example, look at the wedge, right? We have consolidation. Then we have a breakout here, okay? Now, granted, you could always have your pending orders below and above this consolidation zone. That way you can catch the breakout. But the most ideal entry, I mean, I don't want to say perfect, but close to perfect. I would say, hold on one second. I think we got a message. Okay, yes, no worries. I got you. All right, awesome. I got you, Def. Okay, cool. So I was talking about a retest. And so what a retest is almost the same as, let's say, this breakout that you guys are seeing on the left side of the screen, but it has a more higher probability of playing out. You know what I'm saying? So, you know, you can get a breakout here off this wedge, but I mean, sometimes it may come back and fake you out. So when we get a retest, you know, that's what we want. Okay, now you can get a retest out of a consolidation. You can get a retest out of a wedge. You can get a retest off the uptrend or a downtrend. Retests are just a more official way of entering and confirming, you know, that market is about to move in the opposite direction, or, you know, move in a high amount of pips. So right here we're looking at consolidation. Price breaks out of consolidation and comes back to retest at a support or resistance before officially heading to the opposite direction. Okay, and so here you guys have it right here. So this is consolidation, and you know, we talked about consolidation when price just, you know, is kind of consolidating within the zone. We call that consolidation. Now, usually when you have consolidation, you want to look for a breakout, because, you know, that's just like a volcano before it erupts. it's consolidating, it's just building up that steam before it lets it all out. And that's what a lot of traders look for. So, I mean, you know, a lot of traders just trade breakouts and, you know, make profits off that, and that's fine, you know. But here you guys at the very top right, this is an example of a consolidation with the retest. So price breaks what we call resistance, and then it comes back to that same part and then says hasta la vista, baby. It doesn't come back. It just shoots straight up, and you know, you can catch a lot of pips off that. And so here's another example here at the bottom where we have consolidation, but price breaks down. It breaks out at the bottom, and we call this line, this bottom line, we call that support. So it breaks out of support, comes back to support one last time. We call that the kiss of death. Well, I tend to call it kiss of death, and then bam, it's gone. It's not looking back. And so I don't know if you guys are familiar with this concept. I did cover it last class, but hedging. So what hedging is usually putting pending orders above and below consolidation zones to catch those breakouts, because you may not know where breakout may take place. Usually you can talk, and I mentioned this in the other class, but you can predict a breakout because it can either break. I mean, you can predict a breakout. Like, let's say we have this consolidation zone up at the top right, and you know, news is coming, you know, really soon, and that news that we have is very bullish. You know, like, you've done your research, and you know that news is looking to become very bullish, and so you can pretty much estimate that you're going to have a breakout at the very top of this consolidation zone, because bullish means that the price is going to go up and we're going to enter for a buy, right? And so, you know, another way of, you know, trading breakouts and seeing where it may break out at is also by looking at the higher time frame. And I'll talk about time frames, pending orders later on, but just give you guys an idea of how this stuff works. And so you can look at a higher time frame and see what is showing on the higher time frame. If there's a, you know, let's say we're looking at this pattern here at the very top right. If there's in the higher time frame, let's say the, you know, quarter hour, you know, we have a bullish pattern forming, then I'm expecting this breakout to be at the top, you know, and this could be the 1 hour, you know what I'm saying? So it all just depends. Now, if you can't find news, no problem. You can just hedge it. If you can't find any type of patterns within this, you know, within this time frame or higher time frame, that's fine. You can just hedge it and catch your pips. But as I mentioned in other class, you got to watch out for the market makers, because sometimes they'll catch both of your orders and you know, just drag you on for a ride. So you got to be careful when it comes to hedging and all that stuff. So here's more examples of what a retest is. Okay, so as I mentioned before, you can have a retest on the upward trend, downward trend. So at the top right, as you guys see, price breaks out of the uptrend, then comes back to retest retest the resistance before officially heading the opposite direction. Okay, so sorry about that. Okay, so here we have an upward trend, right? And price is consolidating upwards. Well, yeah, it's just going upwards, but it breaks out of that trend, right? And then it comes back to that support level, right? And now we're thinking, okay, and usually you'll get some type of price action. I mentioned in the class before, you'll get price action that'll confirm, okay, price is about to revert from this zone. So you'll get a break of the support level, price will come back, and then, you know, it's gone, you know, and you can get a lot of pips off these moves, guys. I'm telling you guys. Here's one that I called a couple of weeks ago. And so this is a downtrend now. This isn't an uptrend, it's a downtrend, because if we're looking left to right, you know, overall trend is going downward, right? And you kind of have this little zone where price is bouncing up and down within this downward consolidation zone. And then wham, it breaks out, comes back, kiss of death, and then bam, it's gone. It does the retest and it's gone. And so here's an example, just using lines to give you guys a better image of what really just happened. So price just at the bottom right, very bottom, last picture, price was just consolidating downwards, and then it broke out of that support or resistance level, and then came back down to resistance one last time, and then took off. was never found again. So, that's usually how it works. That's how you want to locate these retests. And I honestly prefer to see a retest versus just a breakout, because those breakouts can sometimes be fake outs. And retest too, sometimes, you have some fake outs on retests. And always remember, nothing's 100% in the market, but we're always looking at numbers and percentages. And when it comes to retests, I definitely see a higher percentage versus just a breakout. All right, cool. So retests can also be seen on wedges. You know what I'm saying? So, price breaks out of the wedge pattern, then comes back for a retest before officially going the opposite direction. And so, you can hedge, if news isn't giving you a direction as to where this pair is going after this breakout, or you can just look on the higher time frame and see, okay, well, where's this pattern going? Is it going to go up or down? And usually you can see that because the higher time frame has either a bullish or bearish pattern forming. So another way you can find that out is also by just looking at this particular time frame and seeing if you have any patterns that can lead you to where this breakout may be. But if not, your last opportunity. Your last opportunity can always be the hedge. And I talked about hedging before, but you guys can see there at the top right picture, you have price just consolidating. And like I mentioned before, it's like a volcano. All that steam is building up, and it's just, I don't know if you guys watch Karate Kid, when he's getting bullied, he just let it all out and bam. Same thing with the market, okay? So it was consolidating is getting even more narrower. So that means the intensity of the breakout is becoming stronger, and bam, it breaks out right above the wedge, comes back to retest, bam, and it's gone. Same thing here at the bottom. We have a wedge, and so price is consolidating, and it's becoming more frequent in consolidation, and then bam, it breaks out of that, comes back to retest, and that's what we're looking for. And the most best opportunity is also when you have price action too. So you get retest, and then you see for this example, you want to see like bearish price action. So like an evening star, if an evening star would have formed right at this support level, and you got a retest, oh man, this game over. And then on top of that, it's a high risk reward trade because it's a high reward trade because or it's a low risk to reward trade because you can then put your stop loss above that, evening star candle, before above, the middle of the evening star candle, and just let it ride. And usually, man, you're talking about big gains. So, retests are very important. You'll see them very often, and it's always good to take advantage of these retests too. All right, so today we're going to talk about divergence, okay? Now, with divergence, there's a tool that we call the RSI, which stands for the Relative Strength Index. And pretty much it's just telling you, like, how frequent a pair is being traded. You see what I'm saying? So, for example, let's talk about Bitcoin. Okay, so Bitcoin seems to be dropping, right? But one thing that kind of that kind of caught my interest is that although it's dropping in price, its RSI is rising, meaning that the use of Bitcoin across the world is increasing. So, the fact that price is rising to me is just a false move because the use of Bitcoin is increasing. So that tells you a lot. It tells you what's going on behind the scenes. And it gives you like an early indicator, what to expect. Right now, I think Bitcoin is at 9,000, and it was at 5,000. I want to say last week or the week before. So, I'm not predicting anything really, but I really see it going up in the future because the RSI, the Relative Strength Index, is showing bullish momentum. And although price is showing bearish momentum for Bitcoin, behind the scenes, Some things are going in the way. So, and I know you guys might go to Las Vegas and see these Bitcoin machines, and it's just it's evident, so it's not hard to see. But so divergence occurs when price is going in one direction, but the relative strength of price is going another, also known as the relative strength index. The RSI shows the amount of people actually trading a certain pair behind the scenes, as I just mentioned, right? So here in this image, you got price. You got price pretty much trading higher highs, right? And so if you guys watched the last video, I talked about higher highs and lower lows. And so here price goes up, comes down. So actually here price goes up, creates a high, comes back down, and then goes up again, creating an even higher high, right? And then comes back down and probably creates an even higher high. But notice that you have, if you could draw a line, and usually this is how you can tell if you have divergence, okay? So you have price. If you can draw a line, let's say we're in a bullish trend, right? Which we are in this image. Now in bullish trend, you always want to look for, you want to draw your line from higher highs to higher highs to find out, what I'm saying, whether or not we have divergence. So here price is showing that, we're going upwards. But look at the relative strength index, right? It's showing the opposite, right? It's showing that the steam of traders trading this pair is starting to go down. And so that means this pair is ready to go down. And so now, as you can see here, we do the higher high. We look at the higher high at the same exact level as this higher high, and then start that line there. And then we bring this line to this lower high actually. And we got to make sure that it's the same exact spot as this higher high up here. And once you do that, you find that they're different. You see how one's going up and then the other's going down? That's what you want to see. Sometimes this may even go straight. It might not even go up or down, it just might be straight. And we still look at that as divergence. Okay, so just keep an eye on that. And this is, what this example just includes what we call regular divergence. Now, there's two types of divergences, and I'll cover those later on, actually within this PowerPoint. But right now, what you guys are seeing is what we call regular divergence, and that means like the price is about to reverse. Okay. All right, cool. So, trade divergence. There's two types in the market. We're going to talk about hidden divergence first. And it's used to show trend continuation. So regular divergence show trend reversal, but hidden divergence just shows trend continuation. Hidden divergence used to show trend continuation, as I just mentioned before. But I want you guys to watch this video real quick. I'm gonna turn off the music, although I know you guys were enjoying it. I'm gonna turn off this music real quick. We're just gonna watch this video, just so you guys can see, get a little feel about what is hidden divergence. Bullish trend and a bearish trend. The next thing we want to look at is okay. Bullish trend and a bearish trend. The next thing we want to look at is hidden divergence. And there's a common mistake made between the two. So I'm going to go through what hidden divergence is and how you can use that. And it's really more for a trend continuation style of trading. Right, so as well as using RSI as a signal for potential trend reversal, they can also be used as a possible sign for a trend continuation. Now, hidden
bullish divergence happens when price action is making higher lows. Okay, each time we put in a higher high, we make a higher low. Okay, and the RSI is making lower lows. So you can see we put in our higher high, higher low, but you can see RSI is actually making a lower low here. All right, and this can be seen when the pair's in a bullish trend or an uptrend. And once price action makes a higher low, look at the RSI. If we've got a lower low, that means we've got some hidden divergence, which can be a strong signal for a trend continuation. And you can see in this case, we continue to the upside. Okay, so that's an example of hidden divergence in a bullish trend. So lastly, we've got a bearish trend. So here, for instance, we are in a downtrend, and you can see as price action puts in lower lows, lower highs, you can actually see that the RSI is actually putting in a higher high here. Okay, there's some divergence on this. We've got a lower high, we've got a higher high on the RSI, which indicates a hidden bearish divergence. And then what you see is a trend continuation to the downside. Okay, so those are the examples of the four main common confusions. So we get asked questions about what is divergence, what is RSI divergence, what's regular divergence, what's hidden divergence, and those are some examples for bullish and bearish, both regular and hidden. And what I've done is I've created a little PDF cheat sheet type thing that you can go and download. It's below this video. Yeah, it's yours to download, print out. I recommend that you just keep it above your trading desk just for a reference. All right, so that's it, guys. And if you're interested in learning about the RSI, remember you can go over and grab that FX Basics course as well, which is down below. Everything you need to know to get started without jumping into a huge investment. Very cheap course, well worth the money. And if you're thinking about getting your feet wet in trading, it's definitely the place to start. So till next week, guys. See you then. All right, guys. So that was it. That was the RSI divergence video.
All right, guys. So that was a little bit about what hidden divergence is all about. But yeah, so we're just going to go on to a regular divergence as well and, go from there. So let me pull up that chart. If not, talk about a little bit of what we have left. So as he just mentioned, hidden divergence is pretty much when price is showing higher lows. I mean, pretty much, price is in the, assuming that price is in the downtrend and the RSI is showing higher highs, or vice versa. Price is in the uptrend and, price is showing higher lows, where in the RSI is showing lower lows, then, we have hidden divergence. Now, do keep in mind, although I rarely use this, that doesn't mean it can't change. I'm learning things as a trader every day, and one thing as a trader, you will never stop learning, ever. If you ever stop learning, then from that day on, you stop learning. I really feel like you're just really going down. You always have to be learning, always have to be looking for new ways to, sharpen your craft and all that stuff. So do bear that in mind. But that doesn't mean it can't change. So let's see. Okay, but another thing I want to tell you guys about, mainly the difference with hidden divergence and regular divergence. So with regular divergence, you guys can see that we're looking mainly at the top of price, and we're also looking we're judging things mainly off the top of the RSI, right? But it's different when we're looking at hidden divergence. Hidden divergence, we're looking more at the bottom of price, and then we're looking at the bottom of the RSI, because we're trying to see if price is going to continue. If we have hidden divergence, that means price is going to continue in the trend and it's not going to reverse that trend. Okay, so that's the difference. So these orange bars really be measured at the bottom. So I'll just simply would grab this orange bar, connect the lower highs here because it's an uptrend, and then do the same for the RSI and see if we have any type of hidden divergence. And that'll be how you want to calculate whether or not you have any type of divergence. Okay, so just letting you guys know the difference, but beforehand and seeing that stuff as well. All right, so we did just talk about regular divergence, which is used to show a trend reversal. So for example, if price is making a higher high, the RSI should also be making a higher high as well, just showing everything's going in alignment, that the traders are actually trading the way the price is going. Now inversely, if price is making lower lows, then the RSI should also be making lower lows as well. But when price is making a higher high and the RSI is making a lower low, that is when we now have divergence, and vice versa. So right here I'm only showing an example of an uptrend, but it can vary. It's just the opposite. If we're in a downtrend and we have lower highs on the price and the RSI is showing higher highs, then obviously we have divergence, right? So it's really just used to show when price is running out of steam, whether bullish or bearish. And also if you had a pattern, let's say in this example we had a bearish pattern, that's even more confirmation that it's time to enter into a sell. And then another confirmation would be, let's say a price, as you guys can see, price is at the top, price is at resistance. Usually it bounces down off resistance. Usually we have a bearish imprint off resistance. So that's one thing you want to keep in mind, that just because I'm only talking about regular divergence now doesn't mean that that's all we'll be covering. Okay, and so just keep that in mind. And when you guys are trading, just keep that in mind and make sure that you guys aren't just like tunnel vision on one strategy, or you're just using one confirmation, because that's not how you guys want to trade. Sorry about that. I'm trying to get the music going. 1 second, guys. We were at 28. Sorry, guys. I just feel kind of weird talking. Like, I don't know. Maybe it's just me. Okay. Okay. But yeah. So I can point out a couple of different ways you can look for confirmation. And as I mentioned earlier, it's just like if you were to go to court and you have defendant, and you have the prosecutor, right? The more evidence the prosecutor has, the more likely the judge is going to go with the prosecutor. The more likely whatever the prosecutor is saying has actually happened. It's the same thing on the markets. Okay, so like looking at a chart and you see like multiple indicators. You got bearish divergence, right? Price is at the top of it's at resistance, and we know usually when price is at resistance, it goes down. And let's say on top of that, it created an evening star. I mean, you have 3 different confirmations there that's telling you price is dropping. And so the more the better. And that's how, when I talk about numbers, that's pretty much what I'm trying to embody within you guys, is that you just don't want to look at one little thing and say, oh, price is doing that, And that's why I'm teaching you guys like the key high probability patterns, because these patterns all seen at once are very, very strong. You know what I'm saying? They're very, very, very strong. And I really feel like what you guys have right now should be enough to get you guys going. Granted, you guys are gonna make some mistakes, but some of this stuff that you guys are learning is really very, very crucial, and some very good stuff as well. So just talking a little bit about that, about regular divergence. I know it might be a little bit too much for you guys right now, but I promise you, You know, it'll be just second nature. But I want to ask any questions. I want to ask a question. Does anybody have any questions? Anybody have any questions so far? Man, I must be. Ooh, I must be. Man, you guys make me feel like a really great teacher, man. Cause I mean, I have no questions. So I guess that's a very good thing. Then I guess my explaining is very good. So what we're gonna do right now? We're gonna take a quick break. My mouth is getting kind of parched right now, so we're gonna actually take a quick break, and I'll send you guys a new ID, and I'll see you guys shortly. All right.